Dark Side of Wall Street. We dive deep into the shadows of this financial powerhouse. From historical scandals to modern-day controversies, we uncover the stories that reveal the true nature of Wall Street. Chapter 1. Historical Scandals. Journey begins in 1929, a year that will forever be etched in history. The stock market crash of 1929 marked the beginning of the Great Depression, a period of unprecedented economic hardship. What caused this catastrophic event? Speculation. Investors bought stocks on margin, borrowing money to purchase shares. Overvaluation. Stock prices were grossly inflated, detached from the company's actual worth. Panic selling. Once the market started to decline, panic ensued, leading to a massive sell-off. The ripple effects of this crash were devastating. Banks failed, businesses closed, and millions were left unemployed. It was a stark reminder of the perils of unchecked financial speculation. The Enron scandal. Fast forward to the early 2000s, and we find ourselves in the midst of another colossal scandal. Once a darling of Wall Street, Enron's meteoric rise and fall exposed deep-rooted corruption and fraud. Enron used complex accounting practices to hide debt and inflate profits. Executives engaged in insider trading, making millions while the company crumbled. Enron's collapse led to billions in losses for investors and employees. Enron's bankruptcy in 2001 wiped out $74 billion in shareholder value and led to sweeping reforms, including the Sarbanes-Oxley Act, aimed at improving corporate governance and accountability. Chapter 2. Modern-day controversies. In the digital age, the rise of high-frequency trading has transformed Wall Street. Using sophisticated algorithms and powerful computers, HFT firms execute trades in microseconds, seeking to capitalize on tiny price discrepancies. Speed. HFT firms can execute thousands of trades per second. Advantages. These firms often have access to faster data feeds and direct market access. Controversy. Critics argue HFT creates unfair advantages and increases market volatility. Insider trading remains one of Wall Street's most persistent problems. Despite strict regulations, the lure of quick profits leads some to trade on non-public material information. Insider trading undermines market integrity and erodes investor trust. Each high-profile case serves as a reminder of the ongoing battle to maintain a level playing field. Chapter 3. The influence of big banks. The phrase "too big to fail" became infamous during the 2008 financial crisis. Major financial institutions, whose failure could devastate the global economy, were deemed too significant to collapse. The 2008 crisis exposed the vulnerabilities of a highly interconnected financial system and led to significant reforms, including the Dodd-Frank Act, aimed at preventing future crises. The LIBOR scandal rocked the financial world in 2012, revealing that major banks had been manipulating the London Interbank Offered Rate, LIBOR, a critical benchmark for interest rates globally. The LIBOR scandal highlighted the extent of unethical behavior within some of the world's largest financial institutions, prompting calls for greater transparency and oversight. Regulating Wall Street is a complex and ongoing challenge. Various bodies, including the Securities and Exchange Commission, SEC, and the Commodity Futures Trading Commission, CFTC, oversee different aspects of the financial markets. Despite these agencies' efforts, regulatory gaps and enforcement challenges persist. The sheer complexity and speed of modern financial markets often outpace regulatory capabilities. A significant issue in financial regulation is the revolving door phenomenon, where individuals move between roles in regulatory bodies and the industries they oversee. While some argue that industry experience is valuable for regulators, the potential for conflicts of interest and regulatory capture cannot be ignored. The ethical landscape of Wall Street is fraught with dilemmas. The relentless pursuit of profit often clashes with broader societal values and ethical considerations. Ethical lapses on Wall Street have far-reaching consequences. From financial losses to reputational damage, efforts to instill a culture of integrity and accountability are ongoing but challenging. Public perception of Wall Street is often negative, fueled by high-profile scandals and a perception of greed and inequality. Movements like Occupy Wall Street have highlighted the growing discontent with the financial elite.